Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Atira binti Zainuddin. Today I will like to present the topic about tax administration of a company. And the first question is the settlement of the resident status of a company in Malaysia. There are two resident status in Malaysia. The first is a Hindu joint family, which is a manager or kata is a resident. And the second is a company or a body person, and it divides in two categories, which is a carrying on a business and not carrying on a business. And firstly, a company or a body of a person not being a Hindu joint family carrying on a business or businesses is resident in Malaysia for the basis year for a year assessment if any time during the basis year. Secondly, any other company or a body of a person not being a Hindu joint is a resident in Malaysia for the basis year for a year assessment if any time during the basis year the management and control of its affairs are exercised in Malaysia or its directors or other controlling authority.
Assalamualaikum warahmatullahi wabarakatuh. I am Hanimah Syafiqah binti Yazid. I will present distinction between resident and non-resident for the company. First, double tax relief for resident is applicable and for the non-resident is applicable. Second is incentive available under the Act, and PIA 1966 is yes for resident while no for non-resident. Third is withholding tax section 107A, 109B and 109F of the Act is not applicable for resident and applicable to non-resident. Third is business income taxable is deemed dividend from Malaysia for non-resident only taxable if the truth of permanent establishment or business presence exists in Malaysia. Okay, I will continue with IRB practice for company to be resident in Malaysia. Company required a confirmation of its resident status may apply to the respective assessment branch to issue the COR. COR is certificate of resident can be applied manually or through online portals such as e-resident, tax resident. Status can be easily confirmed based on its prior year tax return.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Fatihah binti Razak. So today I would like to make a presentation on the topic tax return for company. So the company needs to fill the tax return form, which is Form C, where grace period for submission via e-filing. The period within 8 months from the date following the close of accounting period, and due to failure to submit within the line stipulated date, the penalty can be imposed under Section 112 subsection 3 of ITA 1967 based on the due date of submission of income tax return form.
Assalamualaikum warahmatullahi wabarakatuh. My name is Rabiatun Nabila binti Muhammad Kimura. Okay, now we proceed to this the next question, which is what is the procedure to comply company under SAS? The first one is estimation of tax payable. According to Section 107, subsection 3 of the Income Tax 1967, it states that the company is required to furnish the estimate of income tax payable in Form CP204, 30 days before the beginning of the basis period. Next, the second procedure is installment of payment tax. The payment will be made by the installment. The installment begins from the second month after the start of the company base period before the 10th day of each month. Next, the company must determine the tax payable. Then the fourth procedure is the company has to lodge tax return. After that, the next procedure is the company must remit tax liability to the IRB. After remits tax liability to the IRB, the company has to compute income tax liability. And the last procedure to comply under SAS is company has to furnish tax return.
Now let's move to the penalties and offences due to disobey SAS. Under Section 13 subsection 1 with Section 12 subsection 2, offences of failure to lodge with the Register of Company and annual return for each calendar year not later than 1 month equal to 30 days from anniversary of incorporation date. So, due to these offences, maximum penalty will be imposed is Rm 50,000. Next, offences of failure by the director of company to prepare audited financial statement within 18 months from the date of incorporation or within 6 months of its financial year end. So, due to these offences, maximum penalty will be imposed is Rm 50,000.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nurul Syairah binti Ishaq. So I will continue with GST and SST. Okay, so first, history about SST, GST and back to GST. Okay, on 1st April 2015, the Malaysian government has announced that it will implement a goods and service tax GST of 6%. Then 1st June 2018, GST at the standard rate of 6% will now be subject to GST at 0 rate. Then on 14 August 2018, Pakatan Harapan has replaced GST with SST. After 3-hour debate, the sales tax bill was passed. Then on 15 August 2018, after Finance Minister Lim Guang Eng read the bill for third time, the Parliament has passed the Service Tax Bill 2018 through voice note. Then on 28 August 2018, legislation to implement Malaysian new SST and repeal the GST has received royal assent and as published in the official gazette on 28 August. So GST will end and SST will be applied as from 1st September 2018 on 31 August 2018. Okay, next we move to difference between SST and GST. Okay, first, SST is a multi-level tax system for most business and industry, including manufacturer, distributor, retailer, and consumer. For GST, it is a single tax imposed of factories or importee and 10%. Then, for GST, it's more transparent, effective, efficiency, and business friendly, but for SST, it low transparent. Next, the rate for SST may vary or could be differ from 5%. Normally, manufacturers and distributors do not show the SST rate to consumer, but for GST, consumer know the real deal and only at one standard rate, which is 6%. Next is for SST, it showed that input tax can be offset against output tax, but for GST, there is no tax credit mechanism. So, last but not least, for SST, they can return file by monthly, quarterly, and for GST, it's return file on monthly basis. Okay, that's all from our presentation. Okay, thank you.